Good afternoon, everybody. I think we're going to go ahead and get started. I think there will be a few people coming in as we continue here, but I want to welcome you all to our kickoff webinar. This is our 6th year of our not-for-profit symposium here at Anders, and this year we decided to change things up a little bit, and rather than do the big half-day in-person symposium event here in our office, we decided to go forward with a webinar series for all of you. So this is our first one. We're going to pick some relevant topics that we think are some of the most important topics in financial accounting and reporting and compliance and other nerdy accounting topics that we can find for you to try to get some information out. So we'll have a series of these. Our goal is to do them every other month or so, but you will be receiving some further instructions about our upcoming series. So thank you all so much for attending. I want to take a quick second and introduce, if we can move to the next slide real quick. I want to take a few minutes and introduce our speakers today. My name is Jeannie D. I'm a partner here at Anders, and it's lovely to see you all. I'm in charge of our not-for-profit industry niche for the firm, and I do a tremendous amount of work in this space. And today we'll have Brian Losey and Laura Long. Brian's a senior manager in our audit and advisory department, and Laura Long is a manager in our audit and advisory department, and they will be each taking a piece of today's presentation to share this information with you. Just a couple of quick ground rules, just to make sure we've level set here. Go to the next slide. This webinar is being recorded. And I also want to give a shout out to the marketing team. They're working behind the scenes here today. They are outstanding and awesome, and I really appreciate all of their hard work in helping us put this together. They are going to be sending a link in a follow-up email. For those of you who might need continuing professional education, Anders is a provider, NASBA registered provider, so we can offer you CPE certificates, and that's going to be sent out to you. So stay compliant with that. And then if you would use the chat feature to pose any questions along the way, I think what we'll try to do is towards the end of the presentation, kind of filter through and see what kind of questions you have. And then, of course, as always, and at the end, we'll probably remind you of this again, you are always welcome to contact any of us here at Anders. Brian, Laura, and we'd be delighted to talk with you about this or any other financial accounting and reporting matters that come to mind. So I think with that, let's go through the agenda real quick. So why are we here today? Well, you probably know this already, but we have a new reporting standard for in-kind contributions, gifts in kind. Non-financial assets is actually the title of it. And, you know, we were talking earlier before the webinar started. These are your financial statements. And if we're your auditors, we're happy to be your auditors. If we're not your auditors, we want to talk about that as well. But this is not something that your auditors are just doing in a vacuum. These are your financial reports. They're your representations to your constituents. So if it's going to go out to a grantor, a funder, some sort of important constituent of your organization, we feel that those of you that are involved in these not-for-profit organizations as executive directors, maybe development directors, even the financial and accounting staff, really need to have a command and understanding of what are the requirements in terms of disclosures. This is primarily disclosure standard, not really changing the accounting so much, but we're changing what is needing to be disclosed with respect to in-kind contributions. And I feel that there's a really important opportunity to tell your story to your constituents, even in the boring, dry accounting footnotes of the financial statements. There's still opportunities to tell your story, what your organization's doing, how you're accomplishing your mission. So we do want to kind of go through the standard in detail because it's a bit of a change. We're going to give you a little bit of background on how we got to this point, including some of the common issues and challenges around gifts in kind, because they're non-financial, right? So it's hard to place a value on them and so forth. And then we'll talk about the new standard itself and what it means, what's required. We're going to go through some examples to kind of help you understand what's going to be new in your financial statements and in your footnotes going forward. So with that, I think I'm ready to kick it off. So Brian, if you want to take it from here, that'd be great.
All right. Thank you very much, Jeannie. And thank you all for being here. We appreciate it and hope you learn a little bit. So starting off, going to talk to you about the background of why we need this standard. So gifts in kind, starting off back in 1993, the standards came out to recognize contributions at their fair value. So that was way back in 93. And then in 2006, we had the fair value measurement standard come out. And that was written broadly enough that it included both financial and non-financial assets. So that was really the last true update to what we've been doing with in kind. So the principles haven't changed in since 2006. So we're long overdue on some change. And as the markets have evolved and as not-for-profit organizations have really gotten more of a good understanding of what kind of gifts in kind they have, the characteristics and issues surrounding them, all that's just kind of made it more challenging to have some consistency and cause some problems. So it's, again, long overdue, but it's finally here. We have some new standards that we're going to take you through a little bit later. Some of the problems, though, that we have are valuing and recognizing and when to recognize these non-financial gifts. So that can be somewhat of a challenge, and I'm going to kind of talk to you about some of those kind of common problems. If you want to go ahead and, yep. So we have some skepticism from watchdog agencies, donors, and regulators. And the reason for that is they don't really understand where we're getting the value of these gifts in kind from. So when they see any ratios or even the gift in kind revenue and expenses, they're a little bit wary of using that information or really understanding that information at this point. But on the other side, it's very important to your organization. It's revenues that you get from other organizations, and it's expenses that are being expended to help your program. And a lot of not-for-profits really depend on these in-kind gifts to promote their mission. So these are very important things that we want to record, but it does come with some wariness from some of these skeptics. So one common problem that we see is gift in kinds are subject to donor restrictions or legal restrictions, and what that kind of means when we're looking at gifts in kinds. So it's important to get a thorough understanding of the donated asset and whether or not there are legal or other kind of restrictions that affect the value, or just donor restrictions which just impact the classification. So I'll take you through a quick example to understand that. If we're dealing with an organization that has a mission to help supply pharmaceuticals to a foreign country, if they source medication through another foreign country that those pharmaceuticals aren't legally allowed in the United States, then we have a legal restriction that would impact the value. We're not going to be looking at pricing in the United States. We're going to have to go outside and look at some kind of international guide to get the value of those. So that legal restriction of not being able to sell them in the United States does prevent us from looking at what we might be looking at, and presents a valuation challenge from that standpoint. And then on the other side, if we're sourcing them through a pharmaceutical company here in America, then we can look at that value of what those are worth here. But if that comes with a restriction that it must be used outside of this country, then we have a donor restriction, and that is just your classification of with donor restrictions. So just some kind of common things that we see and want you to be thinking about as we move. Another common problem that we have is when you have to make a payment in association with obtaining an asset. So a lot of times you'll get a discount, or a company wants to give you something but requires a little bit of a payment for that. So just understanding, is it a gift in kind or is it just an exchange transaction? So an example of this would be if an organization wants to donate a piece of land to you, and in exchange they want a $10,000 payment to help cover some of the costs, but that land is really valued at $100,000. So you're getting $90,000 of value without paying. In that case, that is a contribution. Now, if it is the opposite, if you're paying $90,000 for a piece of land that's worth $100,000, that's more of a reciprocal transaction, and there wouldn't be the contribution element to that. So just something to be on your mind, just making sure that when you're having to pay for gifts in kind, is it really an exchange transaction, or is there that contribution piece to it? Next, we have some issues in fair value. So I'd mentioned we have to record them at fair value. Now, what is fair value? Well, a lot of times these gift in kinds are items that you're not otherwise buying, and therefore you don't know the markets, or they don't trade in active markets, or if they do trade in active markets, they're not publishing prices for those active markets. So there's all kind of problems with valuing these assets. What we've kind of said to do is look at the markets that you can see, look at observable transactions, and make a good faith estimate on the fair value based on the information that you have available to you. So back to my pharmaceutical example, if you're in the United States and you're unfamiliar with the market, you can always look at state Medicaid or federal Medicare pricing and get information from those sources. Or if it's the international, there's some international pricing guide that you can look at to familiarize yourself with other transactions and get an understanding of what yours would be worth. Another problem that we have is when an organization partners with another organization to provide gifts in kinds. And a lot of times they do this to provide those assets to people that would not otherwise have access to that, whatever it is. So if it's pharmaceuticals, they partner with somebody to get that spread out in the community that might not have access to those. So the biggest piece with this is the non-for-profit acting as an agent or a partner, and is that a gift in kind, or is it a contribution, or are they just merely acting as the agent to facilitate that transfer? So just again, something to consider as you're looking at that, and looking at the agreement is best in that situation. And then finally, non-for-profits need to refresh their understanding and consider market data on a regular basis. This is important because the markets that these gifts in kinds transact in aren't static. They continually change, and it's important to understand it's not a one and done type thing. You need to constantly be monitoring that, making sure that there's no new prices. Your fair value actually reflects the true fair value in the market. So again, not something done in a vacuum. You need to consider all aspects, all things considered, and really get a good estimate on your fair value from that standpoint. And from there, I'm going to turn it back to Jeannie to introduce the next part. Jeannie, I think you're still muted.
Oh, got the mute done. Sorry about that. Yeah, so thanks for that background. Everybody may not have realized all those kinds of problems that are arising. I get phone calls all the time on gifts in kind, on what's the proper accounting treatment. And by the way, we didn't get into the underlying. There are a lot of rules that exist right now for donated services. Those types of rules are not really changing so much, but Brian just explained, there's differences in practice and differences in reporting. And I think that's really important to the not-for-profit industry space, is that if you're going to submit this to a grantor, you want to be apples and apples comparison to another agency that is submitting for the same grant. And the grantors want to see apples and apples. They don't want interpretations on these kinds of matters that vary with the circumstances so much. So we really needed to solve some of these valuation problems, understanding problems that are really prevalent, specifically in not-for-profit accounting and reporting. So just like I think people think this is self-serving for us, that we're it's job security. Maybe it is, but the Financial Accounting Standards Board has developed this new reporting requirement. So I'm going to kick it over to Laura Long, who's going to walk you through the new requirement and what it's all about.
Thanks, Jeannie. And thanks, Brian, for that background. So just to talk about the new reporting requirements, which I know is why most of you are here. The official accounting standard is ASU 2020-07, not-for-profit entities, topic 958, presentation and disclosure by not-for-profit entities for contributed non-financial assets. We don't like to make things short in the accounting industry, so we have to give it a nice long name. The effective date of this standard is for annual periods beginning after June 15th, 2021. So basically the fiscal year that most organizations are currently in. Early adoption is permitted, but again, we don't really need to worry about that at this point. The good news on this standard is that it doesn't really change any underlying accounting. The accounting for in-kind is going to be the same. What's changing is it's primarily a reporting standard. So we'll get into a little bit about that here. The new standard requires the presentation of contributed non-financial assets as a separate line item in the statement of activities. And on the next slide, you'll see how it's broken out on that on a statement of activities. This is just an example that we have from an organization called Save Our Charities, and it shows in-kind contribution is broken out. You'll see it's broken out here in two different places. So you have your regular in-kind contributions, and then any in-kind contributions related to special event revenue is now broken out separately under special event revenue. In the past, you would have seen that gross special event revenue line as one item, as one line item on the statement of activities, and now you'll see it's two items if you have in-kind contributions related to the special event. Another requirement is disclosure of the amount of contributed non-financial assets received that would be disaggregated by category. Now this may be like food. Say you're an organization that accepts in-kind contributions of food, you have baby items, you have office space. All that is going to be shown. We'll show some examples later on, but in likely a table, and then underneath that you'll have more description of with additional information for each category of contributed non-financial asset received. The qualitative information, it also requires that you show the qualitative information about whether the contributed non-financial assets were either monetized or utilized during the reporting period. If utilized, the not-for-profit will disclose a description of the programs that it was used for. So let's just say you're a organization that accepts food. What was that food used for? Was it, used to distribute to other organizations? Was it used to distribute to individuals in need? What were you accepted office space. What was the office space based on? Where did that value come from? And how was it used? Was it used as a, daycare facility, or was it used as administrative offices? So that's all going to be disclosed under the new standard. The next requirement, the not-for-profit policy, if any, about monetizing rather than utilizing contributed non-financial assets. So here's where it's really important for an organization to have a gift acceptance policy. With that gift acceptance policy, you're going to, tell the items which you will accept, and that way somebody's not leaving you something in their will that you don't accept as an organization. Maybe somebody wants to leave you their farmhouse that hasn't been used in 30 years. Well, you don't want that because your organization can't use it. So all of that being in your gift acceptance policy is really important. The requirement is also for a description of any donor imposed restrictions associated with the contributed non-financial assets. So any restrictions that are placed that it has to be used for a specific purpose that the donor would place on that. Also disclosure, as I mentioned, disclosure of the valuation techniques and inputs. So where was the fair value derived from? What was it derived from in order to come up with the amount for each type of contributed non-financial asset? Anything that was donated, any category, where did what valuation techniques and inputs were used at initial recognition? Again, it's in accordance with the requirements in the fair value measurement standard. And then the principal market or most advantageous market used to arrive at a fair value measure if it is in a market in which the recipient not-for-profit is prohibited by a restriction from selling or using. So maybe a donor gives you this non-financial asset and they say, we don't want you to use this for 5 years, or we don't want you to sell this, or don't use this for the next 5 to 10 years. That's going to be important as to what market you use to get that number from, since it's not able to be used or sold. So at this time, we're going to go over a few examples, and I'm going to hand it back to Jeannie to go over those examples.
Okay, thanks, Laura. And actually, before I bring up the examples, I'll have you hold for just a quick second. I want to reiterate a couple of points that you made, because I think because you all know me. If we've met before, then I've probably said you need a gift acceptance policy. So, and if this could be a good excuse, by the way, to go ahead and get that done. If you've had some hesitation from your board members, or it's one of those housekeeping chores that you've put off for a little while, or maybe you have a gift acceptance policy and you haven't taken another look at it. It's a question on the 990. I think everybody knows that. You don't have to answer yes, but it's considered a best practice. So we really do want you, encourage you to take a look at that. Laura's comment about the old farmhouse, I've literally been on a board where we were gifted in somebody's will, a dilapidated old house on the south side of Chicago that we couldn't sell as an organization, that we had to insure and worry about and watch it deteriorate. And it was just very problematic for us. And unfortunately, just kind of came our way and we accepted it. And if you have a gift acceptance policy, there's strategies to make them flexible so that you all can decide, is this the right type of thing? Can we handle this? Maybe we are looking for real estate. Maybe we are looking for land. Maybe we're not looking for those sorts of things. And so you design it that's right set for your organization. It's really the way to go, and we absolutely recommend it. And today's donors do want the option of gifting you certain things, especially in bequests. So we really do want you to use this opportunity, maybe with this new standard, to say, hey, I think we need to dust off this gift acceptance policy and take a fresh look at it as a board, make sure it's in the right place for our organization. So thank you for bringing that up, Laura, because it's a talking point with me, as most of you know. So we are going to spend a few minutes, a lot of minutes actually, on these examples. I really want to go through what they are, what they mean, how they're going to read for you and your organizations. And so, Destiny, I'll go ahead and have you bring up the first one. I got to give credit to the AICPA on this. These are published examples from the American Institute of Certified Public Accountants. Our firm, like most others, is going to design some templates for our clients that meet the needs and meet the requirements of the standard. But all that said, really, these are your financial statements, as I've said 100 times. If your circumstances for your types of in-kind are different or varying, we can work with that. We'll work through the requirements of the standard. By the way, before I even go through this one, as Laura mentioned, on the face statement of activities, where there will be a specific line item for both total in-kind, or all of your in-kind, and then specifically your special events in-kind, if it's material. Some people don't have the material in-kind there. Sorry, my other screen just flaked out here, but sorry about that. Can you all hear me? Am I good? Okay, thank you. So that will be on the face statement, as we've talked about. So now we get to the footnotes disclosures, and some of you have seen some version of detail in your footnotes disclosures before, depending on what type of in-kind you've received. So we're going to start with example one. And right out of the starting gate, we have contributed non-financial assets. So in this particular example, this organization's received for the 2 years. Oh, by the way, it's retroactively applied or retrospectively applied, meaning when you all see your June 30th of 2022 financial statements, if they are presented comparatively, we're going to go back and provide that information for the prior year as well, if that makes any sense. So we have the information, as we pointed out all along. The accounting isn't really changing, but the detail in the disclosure is going to be presented comparatively. So that's important. If we don't think we have enough data to present that comparatively, we'll work through that as we're working through the audit. We'll discuss the implications of that. But I just did want to point out that this is considered, if you're presenting comparative financial statements, it's expected that this will be presented comparatively like that. Okay, so what do we have here? We've got medical equipment and supplies. We've got some auction items. We had some rent in the prior year, and we have some nursing services. So now I'm going to ask to scroll down just a little bit. And the way this particular example was designed is really kind of cool. Each one of those items, because remember, the descriptions and qualitative information that Laura talked about, we always get nervous when the Financial Accounting Standards Board uses the requirement of qualitative information because it's sort of in the eye of the beholder, but they definitely want qualitative and other information about these types of assets by category. So the first bullet, or the first footnote, the first paragraph discusses that the contributed medical equipment and supplies are recorded as in-kind contribution revenue with a corresponding increase in inventory. So we're just describing the underlying accounting that we're performing here. In this case, it's sort of booked to inventory directly, which makes sense for those types of things. We have 3 inventory evaluation methods during the year, and so this is a little more complicated than a lot of organizations would get into, but in this particular case, it makes sense that we're going to follow our 3 methodologies: current price located on a publicly available website if the inventory item is a match for the website where donated, or number 2, percentage of the price located on a publicly available website if the item donated has been used, but the item located online is new, and number 3, current average price located on a publicly available website for similar items of a group. So it's almost kind of that fair value. Think about that, for those of you who have investments in fair value disclosures, kind of our almost like a level 1, level 2, level 3 type concept. What is the active market? What's the principal market? Where are we getting the pricing methodology, right? That's at the heart of this standard. Very, very important. If you would scroll down just a little bit more, next we move into our auction items. So we have some specific disclosures and specific information about the second line in that table above, about the auction items. So we receive items to be sold at our auction, and it's our organization's policy to try to sell any unsold items on various commercial websites used for such purposes. Contributed auction items are valued at the gross selling price received. Donors contributing auction items have restricted the proceeds from the sale to the purchase of personal protective equipment. That's important too. We have, as both Brian and Laura mentioned, often there are restrictions attached, right? Donors can restrict their gifts, and they can restrict the use of the funds from their non-financial gifts or their gifts in kind. So it further complicates how we do the underlying accounting and disclosure for those kinds of restrictions. So in this case, we're telling the reader exactly that we have some restrictions on the proceeds that have to be used for that purpose. Now, I've said all along, we've said this 3 or 4 times, we're not changing the underlying accounting. A restricted contribution is still a restricted contribution. It always has been. So this maybe feels like more detail or a little bit more debits and credits type work, but it shouldn't be. It's just a matter of defining that specific item in the financial statements and disclosing that type of transaction in the financial statements. If anyone on this call feels like, hey, okay, this is going to actually interrupt or change what I'm doing from an underlying accounting perspective, we probably should talk through that, because it just because it's more detailed doesn't necessarily mean the raw debits and credits of the accounting have changed. They shouldn't have. So I wanted to make that clear. Then if we keep going down a little bit more, we have another paragraph that's describing some of the qualitative information about our lease agreement. So you remember that was in on the example above, it was in the 2020 column, not the 2021 column, but that's okay. So that's sort of disclosed here. We have a lease agreement for office space for which the rental payments stated in the agreement are less than the amount than would be charged for similar space that it's rented in similar terms. Using publicly available commercial real estate rental listings, the organization estimates the rental payments to be half of the market price. The amount of contributed rent over the remaining lease term is reported as contributions receivable in the accompanying statements of financial position. So we have a receivable on our balance sheet, and then we have rent expense that's going straight line over the life of the lease. By the way, you all may be thinking, wasn't there just a big lease standard that I have to deal with? Yes, that's true. And if you don't know about that, we've got another webinar at some point. I'm sure that there's lots of people in the audit department here at Anders that can talk you through that. These things have to harmonize, which is maybe a little bit more of a headache than it sounds. But if we're going to be receiving in-kind rent and we've got a lease that's kind of got an in-kind component, we have to pair that up with the new lease. I saw Brian laughing. We have to pair that up with the accounting requirements of the lease standard. So I'm sorry, but the terms and conditions and things like that have to be kind of holistically looked at and in agreement with each other. So this is actually a live example. I've got some clients that have entered into leases under the new standard where we're reporting a right of use asset and a corresponding liability under the new lease. I don't want to get into all of that, but that's the new lease standard. And meanwhile, some of the asset is coming in by way of in-kind rent. So, oh my gosh, you've got a whole bunch of numbers going on here and a whole bunch of accounting going on here. So that's a really important element of all of this, that these standards need to work in harmony with each other. Furthermore, this is a contribution standard, right? So we're in my favorite section of financial accounting standards, financial accounting standards codification, which is 958, which is all for not-for-profits. But we still do have, I think Brian alluded to this earlier, we can have widget maker type transactions as well, right? We can have exchange transactions where we're actually selling, sometimes program service fees come to us. They're not under the contribution standard. We're actually working for those revenues, meaning we have to perform. So the revenue recognition standard comes into play in some respects too. As Brian said, that on that piece of land where we're paying just barely under the fair market value, that's not a contributed asset. We're paying for that, right? That becomes an exchange transaction. That's why it's important that those underlying details are looked at so we really understand what category of revenue are they. So this particular standard is designed to look at in-kind contributions, but they are in that contributions bucket, not necessarily we didn't have to buy them, not the exchange transaction bucket. So it's another element we want you to look at. So if you kind of go further down, so we've covered the medical equipment, the auction items, the rent, and in this one we have contributed services are recognized. So this is the nursing services, if you remember from the table above. So in this case, we actually have services. Remember the specific rules? So we didn't change this. So contributed services are kind of a weird animal because they need to be performed by, they need to be professional services, nursing, sometimes accounting, legal, architecture, those sorts of things. And they need to be performed by the person who does those services. And it usually has to be something that we need to have purchased anyway, right? It can't just, it can't just be something that's on our wish list. It needs to be kind of integral to our, we would have need to have purchased those services anyway. So this one has really not changed at all. It's just delineated again in that example. Contributed services are recognized as in-kind revenues at their estimated fair value if they create or enhance a non-financial asset, or they require specialized skills that would need to be purchased if they were not donated. We get a lot of questions on this, everyone. So, you know, to what extent can I, you know, can I have a donated for my board members serving. Now, you really can't. That's not a contribution. That doesn't really necessarily require specialized skills, those sorts of things. But if you're getting repair work done, some construction work done, if you're getting architectural work done, those sorts of things, we can talk about whether or not it meets the criteria. This particular organization received contributed nursing services that are reported using current rates for similar nursing services. So again, we're talking about our how our fair value measurement works, what market we're in when we're getting that. Organization also receives, now here's another thing, you can still have this statement, and I think it's important and valuable. We have a lot of great work from unpaid volunteers who assist in our fundraising and our special projects. It's just on the accounting standards, we can't put a value to that. We can't recognize that in our statements of activities because it doesn't meet the criteria. But I, as an auditor, most auditors will say, let you have the opportunity to tell that part of your story in your financial statements if you believe that it's relevant and important to the reader to know that I've got an army of volunteers working for me. I think that's fair. I think that's nice, and it connects well. We can put the number of volunteers on your 990. So we can say that here, that we've got a lot of great people working for us and doing work for us. Just under the accounting standards, we're not allowed to recognize that as in-kind activity, in-kind services, unless it meets those other criteria. So the last couple of points on this one, and then I'm going to skip to the second one real quick. The medical equipment and supplies and contributed nursing services were used in our partial hospitalization program. So remember what Laura said. If it's utilized in the reporting period, we need to disclose a description of what programs or other activities they were utilized in. Now, what you all don't see in here is that probably earlier in the financial statements was a description of our partial hospitalization program. So whatever your program may be, we want to encourage you to have in your first part of your footnotes a description of program services, so that when we get to this in-kind piece, we can connect back and say, okay, this was used in our daycare program. This was used in our hospitalization program. This was used in our children's arts program, whatever the case may be. So we need a place to connect it back. And if it's not a program per se, then we can discuss what activity may be underlying the program, or as I think Laura maybe mentioned, maybe it wasn't used in our program at all. Maybe we got donated an air conditioner that we needed for our administrative office. And so we're going to charge that out through depreciation, but that's going to go to management in general in our statement of functional expenses. And remember, guys, that's a hot topic, right? Statement of functional expense reporting is a huge topic, and we're always cognizant of what are our program expenses versus our total expenses. But if we know we have an uptick there because we had to have some work done, or we had to have some in-kind that was really truly only administrative and only management in general, only fit in that category. Well, here's another place in the footnotes where we can kind of connect back and tell the reader, well, that's part of the reason that metric was a little bit higher this year, because we had a specific gift that we could use in administration versus our regular programming. So again, we always talk about looking at the financial statements as a whole. We look at them holistically. So this is one spot where you could go, no, it's okay, donor. I know that my program service ratio went down a half a tick this year, but remember, I got this great in-kind piece that I could use in M&G. That's just an example of how these things should connect for you to help tell your story. And then the final piece is a little bit more on that. The contributed office space is used for both program and supporting services, so we have some split use here, and is allocated based upon square footage. As your auditor, we're going to ask you that question. What's your allocation methodology? Your auditor should be looking at your allocation methodology. Does it make sense? Unfortunately, we can't let you put everything in program if the office space itself is a mixture of both program and supporting services. So we have to be kind of careful about that. You have to have an underlying methodology that's reasonable. And if it changes from year to year, and I think we've talked about this, ad nauseum, but those functional expense ratios, they need to be looked at probably more often than nowadays than ever before. The workforce is shifting. People are working virtually. I mean, there's a lot of moving parts there. So you really do want to be visiting that more frequently than ever before. So I thought I'd make a plug for functional expense reporting as well, because these things are going to hit there, right? These expenses are going to be disclosed now on where they point to on those functional areas. Okay, that was a lot. Let's take a look at example 2, which is slightly different. It's got a little bit different flavor. So example 2, the organization received significant in-kind contributions of time and pro bono services from members of the community and volunteers related to program operations, special events, and fundraising campaigns. We're recognizing this as the same rule as before. We're just kind of stating the rule. We recognize our contributions if the services create or enhance non-financial assets or require specialized skills and performed by people with those skills, and we would have to purchase them anyway. The organization recognizes in-kind contribution revenue as corresponding expense in the amount approximating the estimated fair value at the time of the donation. Okay, that's kind of a statement of almost like an accounting policy. We're just following generally accepted accounting principles. So there's not a lot of specifics in there, just kind of explaining these are the rules that we follow in our circumstances. During our 20X0 fiscal year, we received donated services for tax preparation, legal consultation, and other consulting services. We also received contributions for the use of facilities and donated goods. And can we scroll down just a little bit? And so in this case, they started with the lead in, kind of describe, you know, what you're about to see when you get down to the table, which I think is kind of helpful and a nice way to go about it. We've got these categories. We've got the services, the space, and the donated goods. And then we're going to show on this left-hand column the actual programs that correspond to those things and how they were either charged kind of directly to, in this case, charged directly to those programs, or maybe there's an allocation in there. But you see, as it just said in the previous sentence, the tax clinic program, the financial capability program, and then our sort of other charges, our management in general and fundraising. You might be asking, isn't this going to show up on my statement of functional expenses? Yes, it is. It's going to be back there as well, but nevertheless, this type of detail and this type of qualitative explanation needs to be included in this footnote disclosure. And you probably have some options in how you do that, but since it's qualitative and we don't want to gum up the face statement that's required, let me take a step back from saying that. A statement of functional expenses is technically no longer required, which is a weird thing. So those of you who might be voluntary health and welfare organizations who remember from 8 or 10 years ago that you were required to produce a statement of functional expenses. The standard that we came out with about 5 or 6 years ago, you guys remember my favorite my favorite standard that kind of overhauled a lot of financial accounting and reporting for not-for-profits. It just said that you have to show how expenses are allocated between, have the natural categories expenses, and then how they're allocated between programs and supporting services. But it did not say you had to do it in a statement of functional expenses. It said you could do it there. You could do it on the face statement of activities itself, so the face income statement. That's not really practical in a lot of sense because there's not a lot of room on that statement. You know, it'd be really, really long and gummy, but you could technically do it there, or you could do it in the footnotes. You could no longer do it as a supplementary schedule, which a lot of organizations used to do prior to that standard. Most organizations just converted it to a statement. It's going to be in the 990 anyway. It's easier for the auditor. It's easier for everybody to just get used to reading it on a statement. So it's a proper statement of functional expenses. But I'm an accounting nerd, and I just wanted to make that clear that theoretically you had some options back then. You could still do it. And I still have a couple of clients who do it in a footnote instead of a proper statement. So anyway, back to this mess. This would tie out to that disclosure as well. So if you've disclosed how your in-kind has been expensed, we would expect there to be a correlation or a tie out, so to speak, from this disclosure to that disclosure or that statement, wherever it may be. Hopefully that makes sense to everybody. That was a genie tirade on financial accounting and reporting. But Destiny, you want to scroll down just a little bit more? I want to cover a couple more aspects of this. All of the donated services and assets were used by the programs and supporting services. We have no donor imposed restrictions associated with the donate. That's nice. That's convenient. That was helpful. I get a lot of talk about, is it worth it to take the restriction? Should that be a part of the gift acceptance policy? If they're going to give us some non-financial asset as a gift, should we even accept it if it's going to have donor imposed restrictions? The answer is it depends. Depends on your organization. Depends on what you do, what your programs are, what's right. We love unrestricted gifts. Everybody loves that. Then we as an organization and our board can make the best decisions about how to utilize and how to use those assets. But I mean, restricted gifts are, we'll take it if that's what the donors want to provide for us. That's really more of a development question, and I don't know how development officers, and many of them are on the line today, kind of go through the nuances with the donor and explain, hey, it's better for us if you can make it free and clear for us to utilize as we see fit. So there's no real right or wrong on your gift acceptance policy if it should include language about accepting donor imposed restrictions on those types of gifts. That's something you guys need to work through. And then lastly, the donated space is valued at fair value of similar properties. You saw this kind of before, commercial real estate listings. That's really common, guys, and it's a perfectly acceptable way. The real estate market does change quite a bit, so I think it's another reason why we can't just set this one and done. We kind of have to look at that, periodically to make sure that it's current. But in this case, that's how they valued the donated space. And then the program services were valued at the most recent Bureau of Labor Statistics average hourly wage for tax preparers. I'd be curious to take a look at that. Tax services and tax clinic and credit counselors for the financial capability program in the organization's metropolitan area. I think the message here for everyone is, it has a reasonable methodology. Maybe it's in the eye of the beholder, but if we've got something from a government website, something from a known best practice published, clearinghouse, if you will, that's more often than not, that's going to be fine. The standard doesn't get even more strict with you on that, because it recognizes the fact that we're talking about in-kind. In-kind can be a lot of different things. I mean, it's mind-blowing to consider what types of non-financial assets can be donated to these organizations and how they can be used in programming. So we don't want to overwhelm you with, it asks, you have to use this methodology. You have to use it. You don't. The IRS has some guidelines, and really it's the best fit for your organization, the best fit for your market. Geographic locations or geographic considerations are taken into account. So there's a lot there. Work with your auditor, your financial advisor, to make sure that your methodology is a sound one and it's reasonable. And then finally, the last part of this is that the legal services are included in management in general are valued at standard hourly rates charged. That's easy to get, right, from those attorneys. They should be providing that. And donated goods are valued at wholesale prices that would be received for selling similar products. So that one's pretty straightforward. And either of those methodologies is good. I don't want to spend a lot of time on the third one because it's just another example. We will be happy to share that with you all. I think, actually, before I say that, because it's published by the AICPA, I think we can share our slides, but we can walk you through different examples. And especially if your organization if you're a client here, we can also talk to you about what that's going to look like on your financial statements specifically. So I do want to pause for a minute in the last, what I want to show you one more thing that's kind of crazy, but we're not going to leave on that one. And then we'll go to some questions from you all. So this is a crazy flow chart, and I'm so happy that our marketing team kind of made this, because the original version of this is even harder to read. We tried to kind of simplify this down. This was something that was made available if we're really dealing with a strange in-kind contribution that doesn't fit, that doesn't have a principal market, that doesn't have an observable market, those sorts of things. So this is a very busy slide, and I really don't want to get into the nuances of it, but at the end of the day, it is kind of saying what I was just saying. You have to find a reasonable methodology to get to that fair value that you're going to be reporting for this in-kind gift. So this is kind of walks you through some different strategies when you run into a problem with an observable market. Well, let's do a hypothetical transaction. Is there a principal market? Well, let's find the most advantageous market. And so we've got a lot of weird inputs here, but at the end of the day, the message of this is the expectation is that we've come up with a reasonable way of estimating fair value to record and disclose this in-kind gift. So we'll have that in our slides when we send that out. But it's a kind of a busy one, so I just wanted to touch on it briefly. Okay, we are almost at time, so I babbled on for quite a bit. Does anybody want to put some questions in the chat? And I will kick over to the chat. Any special considerations for donations to thrift stores? Yes. Okay, that is a great question. Thrift store donations, in-kind contributions have for a long time been, they can be quite material, actually. We do work with a number of thrift stores. So there's nothing in this standard that specifically calls that out, maybe is a way to start with answering that question. And it probably shouldn't, because again, the standard is built to be, I guess the way to say this is maybe subject matter neutral, right? They use the examples that they use, and we went through nursing services, rent, auction items, medical equipment, that kind of thing. That's not really the point. The point is what's your underlying, number one, there's a couple of underlying points. Is it monetized or is it used in the reporting period? And if so, what programs or activities was it used for? So then I think in the thrift store, and I have not seen specifically if there is any, if it's clothing, that to me seems like a disaggregated category. If it's household goods, or if it's just kind of thrift store items, if you will. So I think it's kind of up to your organization what level of disaggregation in terms of the categories is going to be the most meaningful and material to your financial reporting. So I say that we'd have to look maybe a little more specifically into what types of items you're receiving, but that would be the general methodology that you would think about when you're developing that disclosure. Hopefully I responded to that question. That's a good question. Anyone else want to put I'm not seeing any. I'll give you one more minute. I want to take a quick second. Okay, I'm not seeing anything else come in the chat. So what we'll do, let's go to the final slide, because I want to make sure everybody has an opportunity. Okay, first of all, thank you again to our marketing team for helping us with this, and Brian and Laura, awesome for you guys. Thank you so much for sharing this information. The three of us sort of oversee all of the not-for-profit industry group activities here for Ed Anders. We're really proud to do this work. We really enjoy it. It's a passion of ours. So as you think of additional questions, or you want help with the standard, or you've got another organization that you think is really needing some additional guidance, and it doesn't even have to be this standard, any of the standards that we just talked about, we're happy to jump in and have a phone call and discuss those with you. I did get one other question while we have another minute. What if the donor does not place a dollar amount on their services? Orthodontist providing services to kids in our care. That's a great question. I get that a lot. In most cases, you would just, again, there's the old question about, is the donor supposed to be providing the fair value? Yeah, and generally we answer that yes, we want them to. I do have some that use some legal services, and they just do sort of a quick average, as to what those fees would have typically been. I would ask those donors as a follow-up just to kind of provide a range. Sometimes the donors don't expect they're not looking for the IRS acknowledgement. But if it's a specialized service, in this case, the question is an orthodontic service, which I'm sure would qualify for that. And also, does the program require that we provide this service, right? So we would have to pay for it if we were not getting the service provided by that professional. So it does qualify under the standards to be recorded, and it should be recorded. So I would just kind of press back. Otherwise, I would just use, again, the different methodologies that we talked about, try to find, in a hypothetical sense, what would be an average for those services, and then that's the number that you go with. Remember to kind of keep it conservative, even though this is just in and out, right? In most of the time, unless it's being capitalized, it's a revenue number and an expense number, but that's important. That's not an excuse to just overly inflate both of those, because we're going to net down to no profit loss impact, as we say. That's not what the standard says. The standard says we come up with, again, a reasonable methodology for identifying that fair value. I think we're done. You guys get an hour of CPE, and we're going to have topics going forward over the next couple of months, so we'll send out some information. Brian, Laura, anything from you guys?
No, just thank you for being here, and looking forward to seeing you in the future.
Okay. Thank you, guys. We'll talk to you again soon. Take care.